clients like there's no tomorrow.
Hello everyone, welcome everyone after the break. Today we will continue with lecture number 13 and we will discuss the second block. We start this block with simulation with Python. So we will do some Python experiments. So in the previous lecture we discussed in detail different VaR aspects, different types of risk measures, coherent measures, and then of course VaR calculations and shortfall and how they are linked together. Today we will do quite some programming. We will be discussing actually real market scenarios. So we have defined a portfolio of interest rate swaps and we will evaluate historical VaR based on real market data. So we will download some market data regarding yield curves from a treasury. So you will this file also with those curves will be available to you. We have to then build up all the scenario, all the machinery to calculating VaR, and then we will analyze what are the VaR quantities, what are the VaR numbers for our specific portfolio we have designed. And of course, not only VaR, we will also calculate expected shortfall for that portfolio we have constructed. In the second part, so we start with the Python simulation also in this experiment, then we go into discussion of on how to handle missing data, arbitrage, and what is the concept of regridding of your curve in the context of missing market data or changes in market data that is going to be used in generating scenarios for your VaR calculations. And then we go into the second part. So we have the second part of VaR calculations. In first part, we concentrated on historical VaR. Now we'll be talking about Monte Carlo based VaR calculations. We will finish with backtesting. So it's a concept of checking of performance of your VaR model. And then we have a summary and one assignment where you will have to implement or extend the implementation for historical VaR with additional risk factor. And also you need to think of how to diversify risks in your portfolio. I think it's a nice lecture. I hope you have a good time. Now is the time to formalize what we have discussed regarding value at risk calculations. And also at the end, we would like to perform Python computation based on some historical data. So let's start with a definition of risk factors and also with their input on how they are going to be used in the simulation. So we start with, of course, the value of our portfolio. So we have this VT0x, and x here represents a vector of state variables. And the state variables are defined as follows. So state variables, you can also think of risk factors. This is how it's commonly named in VaR calculations. So we have this vector of state of the risk factors. So we have x1, x2, and so on. You see those quantities. Those could be, for example, stocks, LIBOR rates, different LIBOR rates, for example, swap rates, foreign exchange, and so on. And you see those quantities depend on time t. So we have this xt is evaluated or has to be filled in basically at every time t. And of course, in the VaR calculations, we have two different schemes. We either perform historical VaR, where this vector will need to be filled in for every historical date of interest. So this typically would be a 250 or 500 historical dates before today. So it's let's say 2 years of historical data. Or it also can correspond to Monte Carlo simulation. So each of those quantities will be quantity that we will simulate. So each risk factor we will simulate, and based on that we will perform also VaR calculation. Important to keep in mind that the objective is not to evaluate the portfolio with historical data, because this is typically how people misunderstand the idea behind VaR. So it's not that you just take historical data and you revalue of your portfolio, because that kind of simulation would not really tell you how much risk you have, let's say, until tomorrow, because we are looking for, let's say, VaR of 1 day VaR. You would like to check whether you are able to, whether your losses will not exceed the quantile or the VaR values. So we are looking from the risk management perspective, whether your portfolio will not suffer losses within some period of time, like for example, 1 day or 10 days. So you are measuring that part. So, but if you would just evaluate your portfolio at some historical data, this will not really tell you whether the losses that you will have, or the expected losses that you will have, what would be the level of losses for tomorrow. Because, of course, if you evaluate your data with historical data from, let's say, 10 years ago, how it's related to possible value of your portfolio tomorrow. That's really not really related. The idea is to forecast or give a distribution for your P&L, for example, for, let's say, for tomorrow or for 10 days from today. So we are looking at the possible P&Ls we can expect, or the losses regarding the P&L in, let's say, in the period of 1 day and 5 days and 10 days and so on. So it's not, again, not about evaluation based on historical data. However, historical data are going to be used as an input for VaR. So what we are going to do, we are going to take today's portfolio, which, let's say, it's frozen. So it means that if we look at the historical evaluations, portfolio composition never changes. That will give us, of course, this kind of stable results. And of course, if you would start changing market data and portfolio composition, that would be very misleading, because you have too many things changing at the same time, that then you would not be able to say whether the profile of your P&L is affected because of the market data or because of the portfolio composition. So therefore, we always keep portfolio fixed. And then what we will do, we will be looking at the historical evaluations of evolutions of your risk factors. And then we will be comparing, let's say, daily increments on daily changes of each of those risk factors. And those changes we will be applying to today's market data. In that way, we can essentially imply, okay, given the historical day-to-day evolutions of our risk factors, we imply them. We assume that in the future, those changes will not be different than historically. And given that, we will be able to estimate the P&L profile for tomorrow, let's say, or for next 10 days. So so again, not based on the historical data, but to evaluate current portfolio while taking into account possible historical market movements. So this is the most important point here. So we are taking into account possible historical movements in order to forecast, to get an estimate of possible value of your P&L for tomorrow or for some other window that we are expecting to calculate our VaR. Market movements can be 1 day, 10 days, or even longer, depending on the risk management or regulator. So, of course, this is kind of another, let's say, a parameter of your VaR calculation. You can specify confidence interval, confidence level, and also how big window for P&L you would like to estimate. And that, of course, if you have a daily, this means you'll be observing at day 1, day 2, day 3, and so on. And if you have 10 days, of course, there will be 1 day, then you have 11 days, and so on. So then the difference between in time is 10 days. And then, of course, those differences that you will expect in risk factors, whether it's day to day or every 10 days, those differences naturally will be larger if you have 10-day window. In the Python experiment, we will also analyze that impact on the distribution of the P&L profile. So VaR evaluations rely, sorry, it's a typo here, on the so-called market scenarios defined as increments of risk factors. So this is how we define scenario. Scenario will be a difference. So we have this state vector here, the risk factors, and we are looking at the difference of those state vectors in time. And this, of course, if we are here T0, we are looking in particular based on some historical data. So here, let's call it S0, and then we go day to day or with some delta T. Then we go day by day or every 10 days or so. And then we are looking at those changes in these vectors of risk factors. So it's not only VaR calculation, it doesn't take place only for one risk factor, for example, for LIBOR, but you could have all sorts of risk factors there. Of course, everything depends what type of risk factors you have in your portfolio. So if your portfolio depends only on the interest rate derivatives, then of course it will be wise to have only interest rate factors in your VaR calculations. If your portfolio involves also some kind of foreign exchange, inflation, or other type of risk factors, then obviously you need to include them in the VaR calculations. What would happen if you wouldn't do that is that in your backtesting,
this is something that we also be discussing in today's lecture, then you will see that performance of your algorithm, also of your VAR, is not performing very well. This means performance is very low. And that means that essentially your forecasting of potential losses that you may encounter in a day or 10 days, it may be not well explained. So losses, realized losses, given the market changes, could be, for example, much larger and happening much more often compared to VAR evaluations. So this is something to keep in mind. So it's very important that the risk factors that you have in your VAR calculations would be realistic and actually be related to your composition of your risk factors of your portfolio. So once we have those scenarios, so differences in risk factors on day to day, so you see we only look at the differences, we never care about the level where those rates are, we only look at daily or delta T changes of those risk factors. And what we do here, we define P&L as a difference. So here is the PV, present value of our portfolio today. So you see here, sorry. So this is the today risk factor. And then we perform second evaluation, where we take also risk factor from today. However, we add those extra shocks that we have estimated historically. So this S, so we are here, T. Then we have this S. We are looking at those changes, and then those changes we apply here to this period, you see? And it's always this kind of composition. We always have risk factor from today plus shock or scenario from historical data. And in this way, we are kind of, the level of our risk factors is fixed because it's given today. However, here we are kind of imply or impose what are the daily possible changes. This is essentially what is happening. We impose daily changes based on historical data, and we impose those changes on today's level of risk factors. And then if you look at those differences, then essentially this difference will tell us what is possible P&L distribution for this period of time. So we have a delta, essentially delta T. So if it's 10 days, then we would have what is possible distribution of our P&L over next 10 days. If delta T is 1, then we have a distribution over 1 day. Of course, you can also do, for example, here we are adding shocks, historical shocks. You can also subtract them. So you can also add them, do both. You add them and also subtract. So there's a lot of possibilities you have. This is why these VaR calculations, although you may have a high-level specifications from regulator regarding what kind of confidence level you should be analyzing your portfolio, but there are some choices here, for example, that you can indeed introduce shocks upwards, but also backwards, because what's the reason that market in particular moved, let's say 2 or 3% in a day? It could also move up for similar reason. So then you can also generate these extra possible scenarios and then also include it in VaR calculations. Question would be, why would you do it? And of course, we as risk managers, we are not interested only to report number that is within a limit and that regulator is satisfied. We are looking for all the possible ways to control risks, because at the end, it is about managing the risks and not only satisfying some regulatory conditions. So our approach for VaR calculations or expected exposures should be that we are controlling, we are understanding risks, and we are protecting the institution we are performing this risk management such that those risks will be controlled and well handled. Okay, we know that, so we are now at this point. Note that in a portfolio, consistent or simple derivatives, so if we have a, consists of. So if we have a portfolio that consists of simple derivatives like spot or other assets, then VaR calculations is very straightforward. We only need to adjust those shocks. You see, for example, here, if this would be, for example, stock value, we only look at the historical data of the stock process, of the stock historically, and then we just add this difference to here. However, in a case of interest rate products, so products that we typically rely on construction of other let's say, yield curves or market objects, then becomes much more complicated, because this means that we cannot just simply shock our
instruments that our portfolio depends on today, but we also have to perform whole construction of a yield curve. So this is important. We build for every scenario, for every historical shock that we will put on today's swap rates and interest rate quotes. Then we have to essentially, if you want to price interest rate portfolio, we have to build a yield curve. Then this means that we have to build, in this case, if it's 100 scenarios, we have to do 100 times, we have to calculate yield curve. And then for every yield curve, we have to perform this evaluation. So you see, it's a little bit maybe computationally rather intensive, because we are not only doing this for one yield curve. Essentially, if you want to do it today, we have to do it for every scenario. We have to essentially calculate yield curve. And then, given the yield curve, we evaluate the portfolio, and then we get our profile for P&L. So now it's a time for experiment. What we will do here, so this is a set I have downloaded. I think this is 160 days historical data for daily treasury yield curve rates. It starts, I think, from the beginning of January 2021. We have a number of instruments, like in the previous lecture when we discussed in lecture number 6, construction field curve. I'll be just looking at those swap rates. So you see, for example, in this is January the 4th, we have some rates. Then January the 5th, we have another set of rates. So we're looking at the differences. So for example, here, this rate has one observation, one scenario is 0 change. Here we have 2, so it's 13 minus 11. It's a 1. We have here 2. We have here 2. And this is 3, 3, 4. And then we do it again. So, okay, so this is one scenario which was with 0, etc. for this factor. Then the second observation will be 1. Then we have another 0, 1, or this will be minus 1, 0. And so you see we will end up with vectors here. Actually, this is 10 to 11, 12 to 10. So you have a 2, 1, 0. So here we vector of 0, 1s, and 2s, of course. This is in a percentage of a swap rate. And then we have another one. So for example, for second risk factor, we have to do it for all the entries, historical data. For 3, and so for all the risk factors, essentially we'll be looking at daily fluctuations. Of course, if we say that we are interested in the VaR over 10 days, then we have to look not only like we did here, but we need to do like changes from here to here. So actually here 10 to 10 is 0, then let's say another here is 0. So this is easier. This is 10 days and 1 day basically it's very much the same. If for example we here, let's go here. So we see before we had 16 to 17, it is let's say 1, 16 to 22, now we have 6. And then, so bigger the steps, you would expect bigger the scenario shocks or scenarios that you have to impose on your simulation of the P&L. And this will be the same here. So bigger the windows you have, bigger the shocks that you would expect to see. That will be, of course, much larger if you have day-to-day. And this is, of course, this is natural, what we expect. We always assume, even if you look at the market data, longer you try to forecast something, there is much more uncertainty in time. So this is the takeaway. So this is the market data. So we will have 160 observations, so 160 quotes for yield curves. We will construct a portfolio consisting of a number of swaps with payers and receivers with different strike levels. So the whole portfolio maybe with 10 or more interest rate swaps. And then what we will do next, we will evaluate the portfolio today. Then we will calculate all those shocks, daily shocks, and then we will rebuild yield curves and then revalue our P&L for the portfolio. And based on that, we will calculate VaR and also expected shortfall. So this is the idea of this experiment. In the VaR calculation, we'll be relying on construction of yield curve that was covered in lecture 6. So if you like to refresh what are the steps in order to build a yield curve given market quotes, then I recommend to revisit lecture number 6. In our simulation, that is we're going to look in a second, we are expecting to see distribution of our P&L or possible profile of our P&L for tomorrow, given the historical evaluations of the underlying risk factors. So be quite few steps we have to perform. This is also the output. So first we would like to see a portfolio value. We would like to see alpha, so the losses. So with 95 or 95% confidence interval, the losses should not exceed this level, this representation. We have also have here the PNL, so here for which is smaller than VaR value, and then VaR value, and then we calculate also the expected shortfall. So first we will establish here the quantile, so for VaR, and then we'll be looking at the expected value on the left-hand side from this quantile, and that will be the loss, the expected shortfall loss. You see that always expected shortfall will be smaller than the VaR estimated. Of course, this determines only the level at which it's a boundary, let's say, between the observations or your potential losses that are in absolute value bigger than that quantile level. So we are looking only at this one, and then we calculate the expectation of this side. Okay, let's take a look at the code. So this is a little bit more different than what we have seen in the previous lecture, because we also have to, let's say, we have this intuition behind building of expected exposures, but now we are dealing with historical data. So of course that requires also certain changes in our code. So okay, what happens here? So first, what we start with, we start to build a portfolio, and portfolio will depend on zero coupon bond. And zero coupon bond, actually, this is what we already have discussed before, also in lectures 6 and 7, is that zero coupon bond essentially is our yield curve. So this means that it's an object that will return discount factors for every day. So here is actually for lambda expression that we will return zero coupon bonds. And then we have a here construction. I have prepared, it's a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 swaps. We have different configurations. We have some of those swaps are for receiver, payer. There are also different rates, different notionals, and different settings regarding the length of the swap. And then each of the swap will be evaluated with a zero coupon bond curve. So we, of course, the yield curve is an input. And then this portfolio is essentially summation of all those derivatives. So if we provide yield curve, the return from this function will be value of the portfolio given that yield curve. And of course, now the question is how to build yield curve based on historical data. So first, what we'll do, we are loading the data from Excel file. So first, I downloaded the data from the Treasury, and then I put them into Excel. This file also will be available for you to download, so you can do that. Then we have this array of the market data, historical market data, and then we also have to divide by 100 because this data was expressed in percentage. We want to have doubles. So what we do, we calculate first number of scenarios. This will be a first entry of this number of rows is number of scenarios. We also have number of instruments. So those instruments are the swap rates of the used from the historical data. Then what we will do, here is the first part. We are going to iterate over all the scenarios, and then we will look at these incremental differences from day to day. So you see here in this code, I have done daily shocks. So we are looking at the day-to-day differences in a market. So you see that we have double loop. This means that for every scenario, for every instrument, we'll be looking at this instrument changes in time. So for example, if we debug this piece of code, so we can actually see here that we have here we would have a scenario. We have market data. Let's take a look first. Market data, it is here. So this is market data that we have downloaded. So every day would correspond to different set of market instruments. So this was the 1-year swap, 2-year swap, etc. And then you see that those are the quotes we obtained from the market. And then if we look at the scenarios, so the metrics with all the scenarios, so this will be here. Those represent differences from day to day. So for example, we have here 13, 14. This was this amount, so it's a 10 to minus 4. Then we have 14, 14. This is 0, 14, 14, 0. And you see that we have all those scenarios for all the historical dates. So if we look, for example, day 135, these are the shocks that we need to apply to today's curve. So for the first instrument, it will be positive shock, then will be negative, negative, negative,
positive, positive. So those shocks that you can see here, those actually tell you how yield curve essentially has moved over one day. This is the kind of scenario we have. And of course, if we have our portfolio consists of yield curve sensitive instruments, of course, this is very valuable information, because this means that it also can happen that our curve will move in the same way until tomorrow. There is a possibility of that. But what let's say those scenarios tell you, they tell you what historically, what are the ranges or possible moves of a yield curve. And that you can apply to today's curve that we have. And of course, this is just a, you can say, historical estimation of possibilities that will happen. Of course, it doesn't really tell you that this will happen, but if you don't have any other information regarding possible yield curve moves, this is of course of added value. Of course, what also can happen is that those scenarios that we have here could be, for example, specified by hand. So this means that we don't specify them as we have here based on historical data. But for example, regulator may say, okay, let's look at the scenario where first swap would move 1% up within a day, and for, let's say, for 30-year swap will move by 2%. This is also possible scenarios that regulator may specify, and given those scenarios, you should be also able to manage your risks. Of course, you should not only prepare yourself for the good times, also for the crises or kind of recessions. Those are extreme and stressed scenarios. This is also why we have here historical VaR. In a stressed VaR, this data would be from the stressed period. So, for example, from period of 2008, 2009, where there was a lot of volatility in the market, and the yield curve, for example, moved much more drastically within a day than, for example, we have estimated based on historical data. So again, there are possible different measures on how to look at your risk profiles based on the historical data. So let's go back here. So what we have here, this is, so we simulated scenarios. So this is this matrix with all the scenarios. We have a swap market. So this is swaps from the market. This means this is a vector of swaps that we see today. So this is, if I would like to price my portfolio today, these are the quotes. Now we also have a second vector is maturity. So this is just specifying what kind of maturities we have in our database, and also what are the corresponding swaps. Later in this lecture, I'll also explain the situation, what to do if number of instruments, or if instruments have changed in time. So, for example, you have additional instruments that appeared to be never existed in before, and now they're present. How to handle those special cases. Now, okay, we have this market data from today. We have scenarios. What we have to do right now, we have to shock. So we construct here, you see, shocked market values. So we take today's yield and we add historical scenarios. This is what we do. So this historical increments we put on the top of current yield curve quotes. So those will be swaps, historical swaps. Let's say the shocked scenarios. What we will do next, in the next iteration, for every scenario, we will build a yield curve. You see that we are iterating over all those arrays, all those rows, scenarios, let's say swaps with adjusted scenarios, and for each of them we will build a yield curve. So this will be this P0T, and then based on that we will just construct a vector of those yield curves. And the next iteration here in this part, what we'll be doing, we'll be evaluating our portfolio for every yield curve that we have just previously constructed based on historical shocks. So we applied shocks to today's curve, then we rebuild a curve, and then we revalue the portfolio for that particular yield curve. And of course, this portfolio PV later we have to use in order to calculate the VaR calculations. So here I'm also doing something extra. I'm also calculating value of portfolio today. We are looking at the histogram of our portfolio with 20 bins. So we're looking at the distribution of possible, let's say, estimated outcomes of P&Ls for tomorrow. And then we have a VaR 5%. We calculate quantile given from our portfolio. So this is the portfolio for all the scenarios. Then we have the VaR estimation, and then we have to go to expected shortfall. To calculate that, we'll be looking at all the portfolio PVs from our vector that are smaller than our VaR estimate. So this is the quantile. We always look everything on the left-hand side from that quantile. And given that, we calculate expected value. So we take those observations, the tail observations, and then we compute the expected value. And this is the estimate for our expected shortfall. So let's run the code. You see now the first step, it takes some time because for every scenario, we have to rebuild a yield curve. So obviously this will take some time. Of course, larger the set of historical data, larger the amount of computational power you need to have to calculate those. However, it's still not so expensive. This is really not optimized code to handle it. And now we have some results. So this is our results. So we have a distribution of our P&Ls. It looks kind of normal. So we also have, this is kind of funny, interesting to see. Of course, those are the flatter tails here on the left and right hand side. Of course, we are only using 160 scenarios and not really stressed scenarios. So I'm pretty sure that this distribution will be also affected if we have more stressed settings. So we have a distribution of our P&L. We also report here that our today's P&L, our PV of our portfolio is 10,000. So we are about here in the middle, 10,000. We have a VaR of minus 7.7 thousand. So this is basically here. So we have a 5% probability chance that tomorrow our losses will be bigger than minus 7,000 or bigger than absolute 7,000. And then we, based on this quantile, we calculate the expected shortfall. So it's minus 16,000. So let's say we have a 5% chance that losses will be bigger than 5%, the bigger than minus or bigger than 7,000. And the expected losses, if we exceed that level, those are minus 16,000. So you see there's almost twice or more than twice we have the impact on expected shortfall against the VaR calculation, except the VaR. Of course, we would like to move this distribution. So of course, if you like to remove this VaR from being negative, essentially you need to add capital cash to your account such that this distribution will be moved towards positive side. Then you can, of course, from risk management perspective and also from the coherent measure we have discussion we have seen, that will essentially would show you smaller impact of your scenarios on your P&L. So this is it. There's in the homework today, you will also have to extend this function to add extra risk factor. We have only done the yield curve, so different swaps. As an assignment today, you will also need to include some stocks here and then perform the same experiment. But I think now it's you can see it's the computation of VaR given historical data. I hope it's clear and it's well understood now. It is not so complicated. It actually only relies on simulating of calculating different scenarios. The difficult part, maybe the time-consuming part, is the construction of yield curve. However, we have developed those building blocks already in the previous lectures, so now we can really benefit from all those past developments in order to calculate VaR. So I hope it's clear. Now let's move forward in the lecture where we also discuss the VaR calculations based on Monte Carlo, which is also kind of very interesting subject to be discussed today. In order to perform historical VaR computation, we need to have a consistent set of market instruments over the whole time horizon where we are interested to calculate our VaR. So this is a very important point. So this data, market data that we are going to use in order to calculate VaR, it has to be consistent. So for example, if you define shocks, if you're looking for the scenarios or risk factors, and you like to observe their day-to-day changes, it is important that the risk factor would exist over the whole period of time. Otherwise, what type of shocks would you apply to today's curves or today's curve that you would like to you need to evaluate your portfolio? So the consistency of the market data is something that you also have to take care of. In practice, there could be, for example, that the case that number of instruments in a yield curve that's quoted in the market has changed. For example, a new, 5-year instrument was introduced, while, for example, other was removed. What to do in that type of scenarios?
So this is also some practical data, not maybe data cleaning, but also you need to have a proper methodology on how to handle, let's say, events, realistic events, that market data, also maybe market data quality, changes over time. So what you can do, for example, which is an obvious suggestion, is to imply the non-existing data. So if, for example, one of the instruments stopped to be quoted or is not liquid enough, you can imply this instrument from existing other instruments. So for example, if you have built a curve, essentially this means that you can always calculate swap for, let's say, 7 years or for 13 years. This is what you can always do. In this way, you can fill in all the missing gaps regarding to the instruments that are not available anymore. It is often the case that instruments that are used for VaR calculations are not implied or, say, determined by the market, but there's, for example, standard set of market instruments that are going to be used. For example, 1-year swap, 2-year swap, 5-year, 10-year, and 30-year. This is, of course, those kind of sequence of instruments is typically established at the higher level of risk management, where you try to associate, let's say, the instruments that are the best representing the risks in your portfolio. So, for example, if one of those instruments, let's say 2-year instrument, would not be available in the market, you would essentially imply it by calculating let's say, interpolating 1-year and 5-year swap. In that way, you would be able to express your risks also in terms of a 2-year swap that doesn't exist in the market. However, in that way, you are consistent, and you still, in this way, you would handling the missing market data. Otherwise, you'll be looking only for the data that doesn't change. It could happen that you will be only having maybe 1 or 2 instruments available in the market that are continuously quoted and they are consistent. So this is, of course, market data matter, but also from risk management, you have to make some decisions regarding what data should be used, what data quality is satisfactory for you, for a quote to be used in the VaR calculations. At the end, the data that you're using in your calculations for risks, for VaR, expected a shortfall, or for example, for XVA, those instruments should correspond to market available instruments, because potentially those should be the hedging instruments that you could include in your portfolio in order to reduce the exposures and associated risks. So, like I said, the instruments of interest can be simply implied from existing instruments. However, some additional criteria also may apply. So you can imply the instrument, but also you can impose some kind of delta constraint. So this means that you imply second 2-year instruments. However, you're not only looking that it's implied from other instruments, but for example, you're looking at different criteria, like for example, sensitivity. So looking from the, let's say, delta profile perspective, and that you'll be implying a rate for 2-year if it's not available in the market. Another aspect that needs to be taken into account, and this is associated with volatilities, because until now we spoke about the calculations of historical data and based only on for interest rates. However, there's also a case that you may have, for example, options in your portfolio for which you would like to calculate also the VaR calculations. You need to include them because, for example, options could be to some extent hedges, or the swaps are used for the hedging of the options. So of course there is some kind of netting effect. But of course there is not easy task with volatilities. You can simply, for example, I think the simplest case you can think is at the money volatilities, which is rather straightforward. So you define a scenario, a risk factor that would represent implied volatilities for at the money level. However, if you have, for example, today level of volatility is, let's say, very low compared to what was level 10 years ago, or let's say a year ago. And if you're looking at the shock sizes, so for example, if the volatility last year, so let's make a graph maybe, that will be more illustrative. Suppose volatility last year was here at the money level, and today is here. So this is T0, this is, let's say, let's call it 0 minus 300 days. Let's do it like this. So you see that, for example, here there was a volatility a year ago, or 300 days ago, and the shock size until the next day, it was, for example, it was here. So this is the shock size we observe. However, your volatility today is here, And if your shock size, this shock size, is bigger than this amount, it could happen, for example, that your volatility that you need to use in your calculation would become negative. Well, especially if your volatility is here, then it's definitely would be there. So this is something that you also have to take care of, because the shock sizes, in this case, negative volatility would not make sense, especially in option pricing. So then you have to do some kind of engineering approach and also change your maybe methodology. How would you handle those kind of events? Also, there's another thing, that if you look at the implied volatility smile or skew, that could be a problem that you may actually introduce arbitrage into your framework. And how this arbitrage looks like. So there are two types of arbitrage you can think of. The first one is the so-called calendar arbitrage. This means that option that expires sooner, it is more expensive than option that expires later. This is for the same strike. This is a call option in this case. And there is a second so-called butterfly arbitrage. So the first one is in the direction of time. There is also direction of strikes. So if you construct a strategy where you buy call option with a strike 1, then you sell 2 options with strike 2, and then you buy with strike 3. This is the strategy you have. So you have this kind of a butterfly. This is why it's called butterfly payoff. And what you can do actually, if you divide, because this is what is interesting here, is that you have this relation between K1, K2, and K3. So assuming that the difference between the K1 and K2 and K3 is the same, so it's delta K, you can divide this equation by delta K. And then what happens is that if you look at this limit, and you look at this expression for this butterfly spread, then if you divide by delta K, actually I divided by squared, but this also doesn't really matter, then you will see that you will have a second order derivative of call option with respect to strike. So this butterfly strategy, if your strikes becoming narrower, if this butterfly, so if those strikes go here and this one goes here, these differences become smaller and smaller, then you approximate, essentially this strategy approximates second order derivative of a call option with respect to strike. And that actually you can, if you have a call option defined as maximum S minus K and then with density, you can actually show that this is equivalent with a density of a stock. And of course, if you would apply inappropriate shock sizes or inconsistent shocks to today's volatility surface, what could happen is that your density implied from the volatility surface with applied shocks would, for example, generate arbitrage, in the sense that your density would, for example, become negative or would not integrate to 1. The problem of handling this kind of events, where you have there's an arbitrage in volatilities, or how to check how to handle the arbitrage in volatilities, how to interpolate between different strikes such that when volatilities arbitrage will not be present. These topics I'm going to discuss in a follow-up course. However, please be aware, interpolating volatilities, it's not straightforward and it requires a lot of attention, especially if you talk about VaR. You have additional problem with, for example, volatility becoming negative, which is very risky. So please always be conscious about the shock sizes that this applies to risk factors. You always make sure that it is not only about evaluating algorithm, the evaluation process should also make sense. So we always think that, okay, what in this was good scenario, what if your shock sizes would make your volatility be negative? What kind of consequences would that have for your VaR calculations? In this part, we will be discussing another type of VaR calculations, VaR calculation that is based on Monte Carlo simulation. We already have discussed deeply and detail how Monte Carlo simulations are done, especially for interest rates, where we typically choose whole white model as the standard model for pricing of exotic also derivatives. So here what we are going to do, we are going to simulate a stochastic model for interest rates, and then based on that we are going to perform the VaR calculations. Simulation, of course, will be based on Monte Carlo. What is interesting about the Monte Carlo simulation for VaR is that if we have time till today, we can calibrate our model to either historical data. This is just taking historical data from the past, calibrating our model. That will be associated with a p-measure calibration. Or we can also calibrate our model to market instruments from today. So for example, swaptions, Bermudian swaptions, or other exotic derivatives. And that essentially would tell us what is the market expectation of future derivative pricing. Yeah? So for example, if we have a yield curve to today for 5 years, market expects some rate, 5-year rate to be at certain level. So that will be associated more with a Q, pricing under the Q measure. Here will be pricing under the P measure. And of course, what we are going to do, so first we perform the calibration, and then we are going to, because this picture is not anymore needed, then we are going to simulate our scenarios for a short rate model, and then depending on shocks or differences on then daily basis, on 10-day basis, those shocks will be applying to today's curve or today's market scenarios that we are going to use to evaluate our portfolio. Of course, in terms of Monte Carlo, this is a little bit of you have much more degrees of freedom, because, for example, you can say, okay, I'm only looking for the 1-day scenario. This means you are just 1 day. And of course, if you have 10,000 Monte Carlo paths, you perform 1 day. This means you already have 10,000 scenarios after the first time step. Yeah? So this is, we have 10,000 paths, we already have 10,000 scenarios after just small delta t move. However, you can do it also for every day. So for every day, you could say we are looking at the shocks. So every day that you're looking at the shocks, you have additional 10,000 scenarios. So you see, if you have Monte Carlo, you can take all the shocks from all the historical data, and number of shocks will be larger by number of paths times number of paths that in our simulation. So in this case, we always end up with more samples that we would get from historical data, because historical data is only one path. Essentially, if we go, so this is today, historically we only have one path, and from today we simulate the future. So if it's only one path, this means we only have one set of scenarios, let's say, this path. And here for every path we have different scenarios. Of course, that would imply we have much more samples, much more scenarios from Monte Carlo. And of course, it's also a matter how you choose it, whether you choose only the first day or go through all the timeline of the paths generated. Of course, if you're only looking at 1 day, that's not really reliable, because your yield curve is also moving in time. So more realistic case would be to take also the scenarios from days later after today. So for example, end of the yield curve and so on. Of course, at the end, it is about generating all the possible scenarios, or as many as possible scenarios. In that way, we can improve the quality, risk management quality, because we have more risks under control. We understand better what are the worst case scenarios that we may expect for our portfolio. So our P&L, the distribution will be much more informative to us. And of course, then we can have better overview of the worst case scenario and the best case scenario also possibly. So, okay, what the strategy we are going to take is as follows. We define, again, like before for historical data, we have some vector of state vector or vector of risk factors. We define stochastic differential equations. So, of course, then again, this could be stocks, LIBOR rates, and so on, whatever you want. Of course, we will stick with short rates, because otherwise this becomes a little bit too complicated to explain in this lecture. So we're simulating short rate, and of course, during short rate, for every path we are able to calculate yield curve. This is the advantage of full white model. So we don't need to recalibrate our yield curve. Yield curve for every path is essentially given to us. This also allows us to even further improve this methodology, how yield curve scenarios you should include if you're taking the increments on the full white. So by taking full white increments of the paths, you can also think how we should change the yield curve at that point. So there is a lot of room for improving Monte Carlo. As I have just explained here, this is very, let's say, straightforward approach just to illustrate the methodology, but you have still many question marks here about specific choices I have made, and those can be improved. And of course, from regulatory perspective, it's also a question what is allowed, what is not allowed by regulator. So, okay, we have this holding period of delta t. We defined a change in risk factor over delta t. So this is exactly what we have done before. So we have a new value of our portfolio. So this is portfolio this is evaluated with state of today, so all the risk factors today, plus delta, and then we have those shock sizes from simulated paths. So we take the paths, calculate this delta S, and then we calculate new portfolio. And then we have exactly like in historical data, we calculate P&L based on the difference. Actually, here it's a plus minus. It could be also, we take the value today minus the shock size, or you can take both. You can include, subtract, and also add shock sizes, and then you have more information regarding the possible scenarios of your P&L. And so, few important points before we go into Python code. Revaluing the portfolio in each scenario is considered to be a computationally expensive task. This is also something what we already have discussed. Of course, every path, this means for every path, you have to calculate value of your portfolio. Each revaluation may be very time consuming, especially for large portfolio consisting of complex derivative securities. And often, individual instruments require the execution of numerical pricing routines or even separate nested Monte Carlo. So this means that in our case so far, we already had interest rate swaps. So that's easy, especially in the terms of full white. But what if you have an exotic derivative that you have to perform even nested Monte Carlo simulation in order to price the derivative? That can also happen. So for example, if you have a Bermudan swaption or some callable product, then you would, for every scenario, you need to perform extra simulation in order to get the estimate for the value. And of course, that is very time consuming. The time required to revalue a portfolio is the limiting factor in determining a number of scenarios that can be generated. So bigger the portfolio typically you have, fewer the scenarios you can afford. This is the rule of thumb. Of course, now we are considering a portfolio which is rather simple. So of course, we can push it to the limit. We can try different outcomes for different number of scenarios, because for us now it's the quality of the results is more important than actually reevaluating a real portfolio. So let's take a look. This is again, first part, I'm comparing zero coupon bonds from the market and from the model. We have generation of the paths. Here, this is the important part. So we start to building the profile for our P&L given Monte Carlo paths. So what we are going to do first, we are going to evaluate first the DR. So you see what we are going to do for every number. So we have a step size. So here I'm doing a 10-day VaR. So every 10 days, I'm taking paths from interest rates. I'm looking at the difference. You see 10-day difference in short rates over the period of time. So this is actually what we are going to do. Yeah. So for every paths, we are iterating over the lifetime of short rates, and we are going to take a 10-day difference between the interest rate now and interest rate in 10 days. And this is called DR. So it's our shock sizes. Then what we are going to do, we apply this portfolio, we evaluate portfolio, where we take today short rate value and then impose this shock on that short rate. In this way, we have our portfolio value here. Of course, we can do it much nicer. We can also impose shocks on yield curves. So there is a lot of different ways how to do the Monte Carlo simulation for VaR. I have chosen this way just for illustrative reasons. Then what we are going to do, then we have a very classical approach. So once we calculate the portfolio, we store it, of course, in a matrix. Then we make a vector out of it, just in order to calculate the quantile. And then what we do here for alpha 0.05, we estimate the quantile. And then exactly the same how we have done it for historical VaR, we calculate expected shortfall. So we take expectation of values of that are smaller than the VaR estimate. So this is basically everything which is bigger losses than the quantile, than the VaR estimation, that is going to be used to calculate the mean value, and then we show some results. So let's run it. So you see now we don't need to recalibrate the curve, so it should be much faster. Again, it has chosen very naive curve. We have here interest rate, I think it is close to zero, minus 0.1%. Here we have a nice distribution of our P&L. The red dot here indicates VaR, and then the black dot indicates expected shortfall. So
quantile is here, and then average of all these observations on the left-hand side is the black dot. And of course, here also give some specifications. So value today is about, this is $109,000. The VaR value is 29,000, and then expected shortfall is twice larger, 61,000. So of course, if you manage your portfolio, you have a minus 30,000 versus minus 60,000. Of course, it's a huge difference from the risk management perspective. Somehow you have to reduce this. You can ask, for example, trader to reduce the positions. But of course, then you need to understand what is the composition of a portfolio, what are the most influencing trades that possibly could improve the profile of your VaR calculations. And then we go again to the same discussions as we had for XVA about attributions of trades. So how much each of those trades contributes to overall VaR. And this is a very similar discussion as we had in that lecture. So I hope it's clear. The simulation is very straightforward, also calculations of the scenarios. And at the end, we just apply VaR calculations where we take quantile and then expected shortfall, which is just average of all the losses which are bigger than quantile. And that's basically it. The final subject that I would like to discuss in today's lecture is so-called backtesting aspect of VaR. So backtesting, the main idea is to check whether your model, your VaR calculation, actually predicts well losses. So what that means is that we compare our losses from our VaR. So this is essentially indicating the VaR indicates the quantile, and we compare that versus the realized P&L from the real market data. So this means that every single day we try to forecast based on VaR methodology discussed today, the historical VaR. We try to forecast what is the VaR for tomorrow. And then tomorrow we can actually evaluate our portfolio from tomorrow's market data and see whether our estimates or our VaR, how many times it exceeded the real P&L exceeded the value indicated by VaR. In that way, we can measure the quality of our model for modeling for VaR. So of course, if we have 100 simulations and it happens only once that only one time we exceeded the level, this means we have only one chance that the VaR is not satisfactory, that the losses were larger than VaR. And of course, this is very informative from the risk management perspective, because this also confirms again whether your model that you have used for risk management, it is good enough. Otherwise, for example, it may indicate that the data you have used is not good enough, that market is in a turning point when it's turning, the regime is switching to maybe more extreme events, or for example, this means that also you may be missing some risk factors in your portfolio. This could be also indicative. So if your VaR values would be in multiple occasions would be lower than the realized P&L. So this P&L actually losses are exceeding the level accepted specified by VaR. This could be indicative that you are really having something wrong in your VaR computation. So today I would like to just spend 2 slides describing the main idea behind backtesting. We are not going to implementation of it. However, I think after this explanation, you'll be able to implement it yourself. So the main idea is to count the number of events when the realized P&L breaches the VaR limit predicted a day before. So every day we calculate VaR for next day, and then next day we compare VaR against based on the new market data against the forecast from yesterday. And then we can assess, okay, whether we were within the limit or we exceeded the limit. The measurement takes place over a certain period of time, usually 1 year or 250 business days. So this means that we have typically in 1 year, it's related to 250 business days, because we also have to exclude weekends. We don't do VaR calculations in weekends. Clearly, backtesting isn't able to predict volatile events, as it is backward-looking statistical measure. So if you have very quiet period of time, of course, the historical data would indicate that everything is fine. There is no market, or your model doesn't expect there to be some extreme events. However, if market becomes very volatile, of course,
that would immediately will be present in your VaR estimates, that your losses will exceed the VaR limits, VaR numbers. It can be, to some extent, that improved the number, the quality that we obtain, it can be improved if VaR computation takes into, if we perform it based on Monte Carlo, but also we calibrate it to the market data as we see today. So, for example, we didn't use historical data, but we calibrate stochastic models to the market instruments of today, for example, for swaptions, etc. And then we have more information that would give us more maybe realistic VaR estimates compared to the historical data. So then you always have to balance. Of course, it's good to have multiple models implemented so that you may confront if the VaR predictions from both different models are extremely different, then it should be also indicative to you that something is not going well with your model, or market is simply turning, and then you may want to reduce some risky positions in order to be prepared for this kind of events. As an example, we can consider an asset like FX, so this was the YT, or stock. In the VaR calculations, only historical data will be used. However, if we choose some stochastic processes for these assets, and of course, then we calibrate them to option market, VaR measure may be more aligned with market expectations of possible fluctuations. So this means that by calibrating to the market, we may sometimes get more information that we would get from estimates or predictions from based on the historical data. So again, if you have multiple VaR measures, like you have stressed VaR, historical VaR, and also VaR based on Monte Carlo, then you can really monitor those numbers together, and you see also from day to day how they behave. Then you have nice coverage, whether your model, first in stressed VaR, can handle extreme volatile events, whether your model is well suited on a forecast based on historical data from VaR. Also, the third option, we can also look at the VaR calculated based on Monte Carlo on the parameters implied from the market expectations about the future. So those three measures will be very informative. Also, you can do expected shortfall, looking at those tail risks and see how those would perform. Let's take a look now the backtesting results. So the idea here is that every single day, so here we have those, here is the time axis, we have in days. The dotted lines are the VaR estimates, and then those bars here, those are the PNLs from every single day. So you see that if this happens here, this means that the loss from our PNL exceeded the estimate given by VaR. So this is one of the events. And then if we count them, we have to count them, and then we can actually, if the number of events exceeded the significance level, then also indicates that your model is not good. It means something is really wrong happening in your model. So this VaR indicates a statistical measure on how to check whether your model performs very poorly or well. Of course, it's clear that here the volatile event start to take place. You can see much more bars are much bigger, obviously, but the VaR is always lagging. You can see that although volatility increased here high, the VaR estimate is just here. And then actually when the events start to be, markets start to calm, still the quantile levels are very much high. Yeah? So in terms of potential losses are high. And of course, because VaR is using historical data and it's lagging, so there's a lot of weight on this period. Later, those extreme events are included and they have more weight. And of course, later it happens that the market is quiet. Your VaR estimates are still very large because of this part. So this is consequence of applying VaR. Of course, we didn't specify, I didn't go here into details regarding regulatory conditions, how to measure statistically whether your VaR is good or it's not good. This I leave it to you as the literature study. Here I would like to just concentrate on the methodology behind simulating and evaluating of your portfolio, and I hope I have succeeded in that task. Today's lecture was concentrated on VaR, value at risk measures. We have discussed historical VaR, stressed VaR, and also Monte Carlo VaR. Let's now summarize, let's go through all the points of today's lecture. First, of course, we started with some definitions and what is the idea behind VaR calculations. Then we confronted the VaR calculations against the definition of coherent measures, and I have shown you why VaR, what is the limitation of the VaR measure, and that what kind of improvement can be imposed, and this was related to the expected shortfall. So expected shortfall is the one which satisfies coherence requirements. However, practically, although VaR doesn't do it, it is still a well-accepted measure for risk. Then we went to a topic of expected shortfalls in relation to VaR. Further, we went to the implementation part where we have implemented a portfolio, evaluation of portfolio, and we have checked the pricing against, of course, P&L distribution, and then we applied to measure VaR calculations and also the expected shortfall. The latter part, the second part of this lecture was concentrated on practical issues like missing data, arbitrage, and regridding of your curve. Regridding basically means remapping of your instruments used for your yield curve, and just reintroduce maybe different set of instruments that are going to be used in your curve. And then we went also to Monte Carlo simulation and VaR computation based on Monte Carlo scenario generation. Here we concentrated on calibration to the historical data and also to the real market data or the market data for swaptions, etc. And then the Monte Carlo simulation for VaR would allow you to calculate VaR based on under P or Q measure. And this is also something we mentioned, that it's important from risk management to have a good overview. What are the different VaR measures? What are the risk measures that we can use to monitor the health and the status of our portfolio? And then a few words about backtesting. Now we summarize the lecture, and also there is a homework assignment. Homework assignment is as follows. We have to extend the portfolio use in a historical value at risk calculation. So this is just something we discussed, so that additional risk factor will be taken into account. For example, you can choose a stock or foreign exchange. You have to then download historical data for chosen risk factor and then perform VaR calculations and expected exposures. Think how you can reduce the variance of VaR by adding some additional diversifying derivatives. So idea here, this is a task of being a risk manager. You have to first do a little bit of researching what kind of stock you would like to add to that portfolio, and make sure that the notional of the stock, or you have enough stocks you bought, so that actually it is significant in your portfolio, because right now there are quite few swaps. Those notionals could be much larger than a single stock, so make sure that there is some proportionality preservation between how many stocks you have and how many interest rate swaps. So you have to add this extra risk factor. You have to extend, of course, Python code for that. And then what you have to do, you have to think, if I have some VaR estimate, what kind of swap or what kind of option on a stock or what kind of derivative you could add to your portfolio in order to diversify, how to reduce your VaR. So this is the main objective of this assignment. I think that was it. This was the lecture number 13. I hope you enjoyed. Next time we will summarize this course. I hope you had a good time, and I hope you learned today a lot about what is VaR, how to calculate VaR, and how it can be used, or different VaR measures, in estimating risks associated with possible market movements. See you next time. Bye-bye.